For more, let's bring in Jason Trennert from Strategas. Haven't broken above the morning highs, but it does look like some pretty solid follow through, Jason, considering the setup here is we're coming off of a rally of about 14% in the S&P 500. What do you make of it?
Listen, I think it's clearly a reaction not only to the inflation numbers coming in better, but I think more broadly to the fact that the long end of the curve is coming down. I do think we're in a different regime, meaning I think this transition from QE to QT is a very meaningful change, probably one of the more meaningful monetary policy changes since the late 70s. So I'm a little skeptical of kind of the everything rally, but you don't want to argue with the tape either. This is clearly good news. We think, though, the Fed has a long way to go before it gets inflation to where it really wants to be. So we would still urge some caution here.
So the market pricing has shifted around Fed expectations now for September toward 50 basis points. It was at 75 after the very strong jobs report last week. Do you disagree with that?
I wouldn't necessarily disagree with that. I think at least prior to today, I think, Sarah, one of the things we saw in the Fed funds futures contract is that people were actually taking the idea of a pivot, we think, a little too far, which is to say that they were pricing in easing on the part of the Fed in the early part of 2023. And to us, that's a really hard argument to make. At least historically, the Fed funds rate has never really stopped going up, or the Fed hasn't stopped tightening until the Fed funds rate was above the CPI. And so CPI, in our opinion, is going to come down. That's not surprising, I don't think, given the fact that the Fed is tightening and given the fact that you're looking at base effects. But again, I think you have a long way to go. And I think, it makes sense the Fed would maybe downshift a bit, given some of this better news. But we also try to remind people that this is going to be a process. Unfortunately, I think the Fed has trained everyone to think about economics in V-shaped terms through the use of quantitative easing. And this is going to be more U-shaped. This is going to be more, again, a process as opposed to an event, in our opinion.
So you're not buying. It sounds like you're staying pretty defensive or bearish.
Yeah, I mean, I think, Sarah, I would say we are, to be frank. I mean, bearish is a strong word. I mean, do I really feel like putting on shorts today? Probably not really. By the same token, I don't know if I would really be chasing certainly lower quality companies that are very much dependent upon the kindness of strangers for capital. And that's again, I think, this process where the access to capital,
are you talking about Bed
in our
Bath and
opinion, is
Beyond?
going to change.
Are you talking about Bed Bath & Beyond or AMC? Are you talking about ARK Innovation, which is up 6% today? Where are you going with that?
I think that, I think the access to capital has changed meaningfully from the start of the year. I mean, at the start of the year, you could have gotten funding for like a ham sandwich. And I think now there's a lot of changes that you're seeing, whether it's in the private equity market or the venture market. Certainly, I think given what the Fed is doing, I think you have to expect changes just more broadly in the public markets as well in terms of access to capital. So you still want to be very careful with those names. And again, does that mean you should short them today? I don't know. I'm not that bold or courageous, but I'm not buying.